Well, hello out there, Alliance family. Welcome to our product call today, which we are going to be doing in a little bit of a different format today because it would be a little hard to show you how to do an illustration over a conference call line. So as many of you know, we're going to be doing a webinar today, and I've got with me on the line, some of you may have just heard her, Emily Scanlon, who's one of the senior internal wholesalers for life sales at F&G Life. She's going to be going through the software, so hopefully everybody is dialed in and can see this. But as you all know, we've been focusing a lot on the Indexed Universal Life products and learning more about those. And one aspect of that is learning how to run the illustrations. So once you have a client who's interested in a tax-free retirement proposal, if you will, or talking to them a little bit more about that, how to go through and run the illustrations so that you can generate an illustration to show the client. So that's what we're going to be doing today, is going step by step through running these illustrations. And I do want to remind you, we may have some brand new people on the phone who are not yet contracted with F&G Life, and you are able to get to their illustration software without being contracted. All you have to do is go to the naaleads.com website and go to the F&G carrier page. And don't do this right now because we want you watching the webinar, but on the carrier page, there's a link to the software. So after the webinar, you can go out there and you can download their software so that if you're not yet contracted, you will still be able to get to the software to run the illustrations. But at this time, I do want to pass it over to Emily. And like I said, she is going to be going through step by step how to create these illustrations. And this is being recorded as well, so we will have the recording available as well for you to re-listen to, or if anyone wasn't able to be on the call live, we will have all of this recorded for them with the slides and everything so that they can go back later and go through it. But with no further ado, I want to thank Emily for being on the line with us. She's got a crazy busy schedule, and we really appreciate her taking some time out of her busy day and spending it with the Alliance today. So thank you, Emily, and I am going to turn it over to you.
Appreciate it, Gina. Thank you so much for that generous introduction. I can't tell you how excited I am to be here this afternoon and to share a little bit about how to utilize our software. You know, you have a tremendous team supporting you at the Alliance, and I can't say enough about the training that Gina provides to you. There are few people in the industry with the level of knowledge and expertise that Gina has. So a lot of perhaps what I'm covering here this afternoon may be duplicative of what Gina has shared with you, and that's okay. I want you to encourage utilizing her and her trainings. Some of it will be a refresher, some of it may be new for some of you. Now, my goal here today as your senior internal wholesaler for F&G is not just to show you the illustration software. That's definitely a huge part of our conversation today, but my goal and my approach to training is I don't just want to show you how to press the buttons. I want to help you understand why we're making certain decisions in our case design. So we will get to the illustration software and spend quite a bit of time going through the actual software. So you do actually know what buttons to click, but we'll also talk today about creating effective case design, why we're making certain decisions about funding or face changes, things like that, in order to create the most effective solutions for our clients. So without any further hesitation, let's go ahead and dig right in. Again, my name is Emily Scanlon, Senior Internal Wholesaler for the Life Sales Team at Fidelity and Guarantee Life. Many of you know my colleagues here on the sales team at F&G. Hopefully you've had the opportunity to meet Ryan Parker or Matt Kent at some of the meetings, perhaps Dennis Sudak as well. As a quick heads up, Ryan Parker will be attending the meeting this weekend in Burlington, so I hope you are all planning on being there. You'll have the opportunity to meet Ryan in person, ask him any questions that you may have, provide any follow-ups you have on today's session. So great opportunity to get in front of Ryan Parker as well this weekend, our National Account VP. So let's begin digging in. Quick high-level overview, F&G Life Portfolio, what are we doing here? It's all about the IUL story, the Indexed Universal Life story, which I know Gina and her team at the Alliance have done a tremendous job sharing with you about the value and opportunity that IUL can provide to your clients. So you have that wealth transfer component, you have that death benefit. There is a huge part of our conversation with our clients that's about providing them protection, that they know that that death benefit will be there to take care of their loved ones when they pass away. Now, the focus of our story here today, yes, that death benefit piece, that wealth transfer piece is always going to be there, but today we're really going to be talking about driving the story towards the accumulation and income solutions. So that accumulation, cash value growth within the policy, and then utilizing that to create a tax-free income for our clients. All the while, we have that protection piece of the puzzle, providing living benefits to our clients that they can access their money if they get sick and need the money sooner. So our portfolio at Fidelity and Guarantee Life, perhaps if you haven't had the opportunity to get familiar with us, or just as a refresher, we are entirely focused on the IUL space. That is currently our entire life portfolio is IUL solutions. Why? Well, we're pretty good at it. We've been in the IUL market since 2003. That's our focus, that's our area of expertise, and again, we do it very, very well. And we have two solutions to offer to your clients. We'll focus today on the Life Elite product because we are looking for that accumulation cash value solution. But I want to let you know that we also do have an alternate product called the Life Choice product. When would you be using the Life Choice product? Well, the Life Choice would be your go-to product for slightly older aged clients or individuals who are primarily focused on a low-cost death benefit solution. So they want a long-term death benefit solution that gives them the flexibility of an IUL, a little bit of upside potential, living benefits. Maybe they're looking to replace a term policy that's about to renew at, an exorbitant amount of premium. The Choice is a good alternate for those types of sales. But for the vast majority of your accumulation sales, which is what we're talking about today, creating for our clients the opportunity to access funds on a tax-free basis through their IUL, that's going to be your Life Elite product. Quick overview about the product before we just dive into some case design components. Well, we can issue the Life Elite product from age 0 to 75, and I'll show you today a couple of juvenile scenarios. It's a very popular solution for juvenile sales, creating that multi-generational planning. We begin with a minimum issue face amount of $50,000, so it's really designed to be a solution that can work at a wide range of budgets for our clients. I think it's a common misconception that IUL is only for high net worth clients. It absolutely is not. And we can talk today a little bit about how we can take our clients' budget and really maximize it. No matter what their budget is, how can we use every dollar that they're contributing to work to their benefit? You're going to see really strong performance on max funded short pay cases. We'll talk a little bit more about what that means. That means, again, maximizing the contributions that my client is making, even if we're not talking about high dollar amounts. Now, that accumulation potential comes, one, from just the design and the pricing of the product, gives our clients that opportunity over time to build a really nice bucket of cash value in the policy. Now, an IUL is credited based on the returns of an index allocation option. So it's important that your IUL solution provides your clients with tremendous upside potential in those index strategies. And we have really high competitive cap rates on our S&P 500 index allocation options, meaning that they have tremendous upside potential. And then in addition, we have a proprietary index through a relationship with Barclays, a bank and financial institution you're all probably familiar with or have heard of. We have a strategy utilizing a Barclays index, and that particular strategy is uncapped, which means there's limitless, truly upside potential with a 200% participation rate. So you have a variety of unique index allocation options, giving your client diversification and tremendous upside potential. We'll talk a little bit more about loan options, but one thing that we're very proud of at Fidelity and Guarantee Life is that we offer a 5% guaranteed maximum variable loan rate on the Elite product. What does that mean? Well, that means that over time, in 10, 20, 30, 40 years, when my client goes to borrow out of his or her policy, he will contractually never be charged more than 5% for their variable loans. Now, there's also a fixed loan option, which we'll go into in just a couple of moments, but that variable loan allows the client to continue to participate in market growth even on their borrowed money. And again, that 5% protection is extremely valuable in today's marketplace. Elite product highlights very competitive target premiums. What does that mean for you? Well, commission amounts are based on target premiums. So we know you're out there working hard for your clients, and you'll see that reflected in the compensation as far as target premiums. Downside protection. An IUL, yes, absolutely offers that upside potential for our clients, and that's a huge part of the story. But what happens in volatile markets, in down years, in difficult financial periods? Well, there is protection there, downside protection in the form of guaranteed minimum index interest return, and that's credited on an annual basis. So what that means is that each and every single year, if that index strategy did not return 25 basis points, we are going to credit that amount each and every single year to the client's account value. So it's not always about what the clients earn, but in some cases, especially in volatile markets, it's about what they don't lose. We also offer a persistency bonus. This is an account value credit of 25 basis points kicking in beginning in the 11th policy year. Just give them a boost on their accumulation and continue to grow that cash value going forward. Now, from an underwriting perspective, we're not going to spend a lot of time on the underwriting today, but I want to familiarize you, a little bit with some of the programs that we have to offer. We do offer non-medical underwriting for your clients who are age 0 to 45 and applying for a face amount under $150,000 on the Elite product. So for your younger age clients looking for maybe a smaller face amount policy, they will go through without a paramedical exam, no home office specimen, no blood work. Very straightforward. We can issue up to standard rates on that non-medical underwriting. There is a little bit of an adjustment to their cap and participation rates. In addition, we have an accelerated underwriting program, and we offer consideration for that program beginning at age 18, continuing through age 50, and for a face amount all the way up through $1 million. So if you have clients within that age and face amount, we will review the application and make a determination, and whenever possible, we will approve without medical requirements, traditional medical requirements, but in some instances, we may ask for those. So just wanted to give you a quick overview of some product information, which I know many of you are already familiar with, but perhaps a refresher for those who are new on the line. Living benefit riders, so that additional piece of the puzzle, that protection component. What happens if I need the money, if I get sick and need the money sooner? That's where our accelerated benefits for critical illness and terminal illness come in. Now, one of the great things about our illustrations is that you will actually get a supplemental report with your illustration that will give a clear projection to the client of how these riders work and what their anticipated payouts could be in the future. So I would encourage you to review those supplemental illustrations when you run one with us, because we really feel that's a valuable tool to help your clients understand the benefit of these additional riders. The riders really just function as a safety net. Your client is not going to be charged for the riders unless they utilize them, so there's no cost of insurance associated with having these important protections on your client's policy. And if they get sick with a covered critical illness, or they are diagnosed with a terminal illness with a life expectancy of less than 24 months, they can rest assured knowing that they will have access to their money when they need it most. We've gone through a quick overview of the product. We're talking today about accumulation, talking today about using the Life Elite product to create an opportunity for our clients to access money through policy loans on a tax-free basis. Sounds pretty good, right? Well, how do we make it work best for our clients? Before we dive into the illustration software, I want to share with you a concept that I like to use when I'm thinking about creating an accumulation sale for a client. And it's all about filling the bucket. The bucket is the cash value in the policy. What's going in to fill that bucket is our cash contributions or our premiums. And then over time, as those premiums earn interest based on their index allocation selection, that interest is being credited into the cash value as well. So in order to build that cash value, we're trying to fill the bucket as much as possible. Well, what is going to be depleting the bucket is our mortality and expense charges. Your COIs, how much death benefit am I paying for? That's going to chew away at the growth within my cash value, right? So in order to design an effective and maximized accumulation sale, what we want to do is we want to minimize what's coming out through that spigot at the bottom, minimize what's coming out on those mortality and expense charges, meaning not necessarily giving my client too much death benefit, certainly not more than he needs, so that I can control that spigot down at the bottom and retain as much in my cash value bucket as possible. Makes sense, right? So I need to have a bucket that's big enough to let the cash in, and that's all dictated by IRS guidelines. You got to have a big enough death benefit for what your client wants to pay, but we don't want to be giving them too much death benefit so that they're paying cost of insurance on something they don't need. So we want to maintain that tax protected status by giving them enough death benefit that they can contribute what they want. We want to control the costs and expenses by issuing them with the minimum death benefit or illustrating them with the minimum death benefit within those IRS limitations to give them that growth potential that they're looking for. Again, this is all about that accumulation sale, how we're going to approach designing that powerful accumulation sale. It also works best if our clients have some time, that we can't turn on that cash contributions all the way open up and let the bucket fill quickly. Of course, that's not exactly how an IUL works. It's best if we can put in those cash contributions over time and allow that compound interest to be added in. So again, for your younger age clients who have a little bit of time, this is going to be a tremendous solution. A couple of considerations, thinking back to that bucket concept, and I'll mention it probably 100 times on today's session because I think it's a really valuable concept for us to return to when we think about case design. I have a client that has a large lump sum payment, $10,000, $20,000, $100,000, that they want to put into an IUL. They want to dump it in there. This is great. They can get tax-free income later on. I want them to put all that money in right now and then be able to draw out from it later. If it were so simple, well, that would make my job really easy, but I may be out of a job. Large lump sum payments typically do not work in accumulation sales. Why? Well, if I think about trying to dump in $50,000 into an IUL contract in 1 year, what do I need to be conscientious of? Well, my bucket needs to be big enough in order to let that $50,000 come in 1 year, meaning I have to be within the IRS and MEC limitations in order to allow $50,000 in. What that's going to equal is a very, very high death benefit in order to allow that premium in. And what comes with that death benefit? Higher costs and expenses. So I'm creating a bigger bucket and turning on that mortality and expense charge spigot down at the bottom a lot higher than it needs to be, which is going to deplete my accumulation and really not give my client that upside potential and that cash value growth they're looking for. So what do? Well, I would recommend taking that total outlay that the client wants to pay and redistributing it over a period of time, typically 5 to 7 years, maybe 10 years, depending on how much premium we're talking about. That allows us to control the costs and expenses by bringing that death benefit amount down to a reasonable amount and maintain that growth in the policy because they're not paying for so much death benefit up front. Hopefully that makes sense as we start thinking about these lump sum solutions. And again, I'll show you an example of what this looks like on the illustration software. I just wanted to walk you through it here. Another question that we receive a lot that I want to spend a little bit of time on is death benefit options. You'll have an increasing or option B selection that you can make, or option A, which is a level death benefit. What's the difference? Well, option B, increasing death benefit option, means that the net death benefit, what's being paid out to the beneficiaries upon death, is your base face amount plus your account value. So whatever index interest is credited into the account value, the cash value bucket, that's put on top of my base face amount, and that's what's paid out to the beneficiaries. Pretty good deal if the client is looking to have more paid out to their beneficiaries at the end of the day. Option A is a level death benefit option. That means that what's paid out to the beneficiaries is simply the base face amount. The account value is not added on top of that. Now, we keep things simple on the illustration, and the illustration does all of those calculations for you, but by definition, that's what your options are. So which solution is better? What options do I have for my clients, and how do I design this? Well, if you're looking to create an accumulation sale, you're going to want to control the costs and expenses by minimizing the death benefit as much as possible, right? Again, controlling that mortality charges and expenses spigot at the bottom of our bucket by keeping that death benefit low. So typically, if I know how much premium my client wants to contribute and I'm solving for my minimum death benefit, if I started an option B, I can actually bring that base face amount down a little bit lower. It will still allow the same amount of premiums in, but at the beginning, I'm going to be paying for less in COIs, and this will equal greater account value growth and potentially higher income projections, right? So option B at the beginning will typically mean that we can drive that initial face amount down and get higher income projections. Now, that being said, let's think about how over time the account value grows with option B, or really with either of the options. You have your cash value growing, and at an option B, as that cash value grows, it's being added in on top of my base face amount. Well, my client is going to be paying COIs on the net death benefit. So my base face amount plus my account value is what my client is paying COIs on at an option B. So as that account value grows, it's going to grow exponentially my net death benefit and thus also grow my charges and expenses over time. Now, when the client's paying, that's okay. It's worth it to allow them to put those premiums in and grow that account value, right? But once my client stops paying or over a longer period of time, that death benefit, the net death benefit at option B, is going to start blowing up pretty significantly. And that's actually going to result in higher expenses, higher COIs for my client. So my recommendation for many accumulation sales, it will show you the highest projected loan amounts, if that's what your client is looking for, by starting with option B and then switching to option A when the premiums stop. And we have a simple way of doing this on the illustration software that I'll show you in a moment. Now, that being said, I also very often go just with option A in all years. There's absolutely nothing wrong with that. It's not doing a disservice to your client whatsoever. What option A in all years will do for your client is give them a little bit more net death benefit up front, so they'll have a little bit more protection earlier on if something were to happen, and that's really important for many of our clients. In addition, option A is kind of a set it and forget it solution. I'm going to set them up on option A. I know they're going to have a nice solid death benefit and they're still going to have accumulation. They don't need to make any changes in the future. Whereas if I go option B to A, that's not going to happen automatically. My client is going to need to remember to make that change in 20, 30 years or so at that switch. It's not going to happen automatically. So it's really just a balance. It's a determination that you make really on a case-by-case or perhaps just your general approach to your business. You make a decision about what's going to work best for your clients. The purpose of this is really to talk about what the differences are and what you will see on an illustration. Again, it's not just about what buttons to click, but understanding why. Now, one last thing I want to cover before we get into the illustration software is loans. And Gina and I had a great conversation about the way that loans work, about the way they're illustrated. So I want to share with you a little bit about our insight and how we can approach the different loan options. On the Elite product, your client will have the option of selecting a fixed or a variable loan. They don't need to do this in advance. They would do that at the time that they choose a loan. So this is really just to make a decision about how you want to illustrate, but the client has that flexibility later on to make their decision. Now, fixed loan is awesome because it's really a no-cost loan when it's taken after year 10. There's a 2% net charge if the loan is taken year 10 or prior, but a 0% net charge if it's taken after year 11. Now, what is something to keep in mind about a fixed loan is that it's not a participating loan. What that means is that when I go and I borrow on a fixed basis, what's good is that that charge is set, and again, it's set as a cost-free loan at a 0% net charge if I take it in year 11 or after, but we're actually pulling that loan amount out of the account value. So if in year 20 my client goes and borrows $10,000, that $10,000 is actually coming out of the account value, meaning just whatever is left in the account value is going to earn based on the index returns. That's a fixed loan, non-participating, 0% net charge. Really conservative, pretty safe way to illustrate, and absolutely, doing a service to your client by showing them that fixed loan option because it is 0% net charge. It's a wash loan. Tremendous solution there on the fixed loan. Now, the client also has the option of a variable loan, and here's how a variable loan works. Again, on the Elite product, we're proud to offer that maximum guaranteed variable loan rate of 5%. Now, the primary difference between a variable and a fixed loan, besides just the interest rate charge, of course, is that a variable loan is a participating loan. What that means is that in year 20, when my client goes to borrow that $10,000, if they do so using a variable loan, that $10,000 actually stays in the account value and can continue to earn based on the index strategy returns. Whereas a fixed loan, it's coming out, my client is forfeiting the opportunity to earn on his borrowed money. A variable loan, he can still earn even on the borrowed funds. But there are different ways that this could play out. If the loan is charged at 5% and the index returns 7%, well, great. My client is actually earning 2% even on the money in his pocket. Tremendous solution. He'll still earn that full 7% on the non-borrowed money, but he'll earn 2% even on the borrowed funds. Now, if the index returns the same amount that it's being charged, then of course there's nothing credited and nothing charged to the borrowed funds. Conversely, if my loan is charged at 5% and the index only returns, let's say, 3%, then my client is being charged at a rate of 2% for his borrowed money. So a couple of different potential outcomes. That's all driven really by the index returns. Now, that being said, there are some regulations in the illustration software. And the regulations are designed to protect illustrations from overselling or being overinflated for the consumer. And now I won't dive too deep into Actuarial Guideline 49. I can get super geeky about it, but the basis of the story is this. The NAIC dictates illustration regulations, and one of them is AG 49 that says when I'm illustrating a variable loan, as soon as I turn on those loans, those borrowed funds are only assumed to be credited 1% higher than the rest of my account value. So that $10,000 that I took out in year 20 is now being assumed on the illustration to earn 6%. The rest of my bucket of money, the non-borrowed money, would still be assumed at the normal illustrated rate, but I have a 1% difference. Now, in reality, can the client earn more on their borrowed funds? Yes. But the illustration regulations when it comes to variable loans say that 1% is the maximum. So I offer this just to provide you that background about understanding loans. Today we'll focus on illustrating fixed loans on the software, but I'll show you if you prefer to run variable loans. You have a good understanding now of how they work, what the upside potential is, what the potential risks are, and how they're illustrated. So let's move forward to what we've all been waiting for, the illustration software tutorial. Now this will be a piece of information that you'll want to refer back to. As we go into the software, you will see, and perhaps you've already seen if you've been in there, we have a lot of solves. What that means is that you're asking the illustration software to do some calculating for you, which is great. I'm not a mathematician. Probably some of you are not mathematicians, so it's great that we have those solves on there. But we have a whole lot on our software, perhaps you've noticed. The majority of those solves, knowing what I know about your business, you will probably never use. There are a few that you will use, and these are the ones we'll focus on today. Max Acumen Income is a solve you will use in two different scenarios. I know my client's budget, so I know their premium. I want to generate the most account value growth, the most accumulation over time that I can by showing them the minimum death benefit, and I also want to show my client policy loans. Is that a scenario that you run into quite a bit? I would imagine so. Now, this solve can also be used if I know how much death benefit my client wants, and I want to show them how to max fund that within IRS limits and then also show them policy loans. So this is a key solve that we will walk through together today. Another solve that I know you'll want to use quite a bit is I have a client and I know how much I want to illustrate as far as policy loans. I know that this client is going to want to see $40,000 a year in policy loans when he turns 65. So I have an idea of how much he wants to see coming out of the policy. What I don't know is how much he's going to need to put in and what face amount I need to get me there. So this particular solve, and it's a pretty new one for us, we introduced this last year, so hopefully you see this as a benefit, is that I'm going to say I want $40,000 a year during retirement, and the software is going to determine what face amount, when it's funded at target premium, will give me that loan projection. So it's not a max funded design, it's a target premium funded design, but it will solve for both the face amount as well as the target premium. And last but certainly not least, minimum death benefit. This one's really simple because it's the same as the Max Acumen Income solve, except I'm not illustrating income, so I'm not solving for any loan projections. This is if I know my client's premium amount, so I know they want to pay $300 a month. I just want to see the maximum accumulation, so I want to solve for the death benefit, but I'm not necessarily going to solve for policy loans. Or I know that my client needs, let's say, $500,000 of death benefit, and I want to show him how much is the maximum that he can pay in each and every single year. So these are the three different solves we will focus on today. I'm going to go ahead and close out of the formal presentation for a moment. This, of course, is being recorded, as you know, so we'll share that recording here after today's session because I think that cheat sheet about solves is going to be very useful. Again, as we get in here, you'll see there are quite a few options, but those are the ones that we'll go through today because I believe those are the ones that will be the most valuable to your business. What are we looking at now? Well, I'm on SalesLink, so for those of you who are contracted with us, which I know is many on the line, this should be familiar to you. SalesLink is your agent website with Fidelity and Guarantee Life. You can order materials, you can get your e-app, you can run your illustrations, you can get product information. Lots of great resources out here for you, and this is also where the software is linked, at least the web-based version. So as Gina mentioned at the beginning, you all, whether or not you are contracted with us at Fidelity and Guarantee Life, we want to give you the opportunity to see these solutions firsthand. So we have provided the Alliance back office with a link to download the desktop version of the software. So if you don't have access to SalesLink or you need a desktop version when you're not connected to the internet, you can go to the Alliance website. As Gina mentioned, go into the carrier pages, go to F&G, and that will be available for you. Now, it is a pretty big download. I'll give you a heads up, so make sure we're not trying to download it like 5 minutes before our client appointment. That's where that web-based software can come into play. But you do have access to it, and the great news is it's going to look and feel exactly like the web-based version, which is what I'll be running today. So if we're going through SalesLink, we just bring up the software, very easily linked out here. If you run your cases on the web-based version, it will save all of the clients that you've created, so you can go there by viewing my cases, but today we'll just start a new case. So we'll walk through, first off, a basic scenario, providing my client accumulation potential with policy loans. So I have a client who is, let's say John is my client today. John is, let's say, a 40-year-old male. Now, I mentioned at the beginning that I am located in Lovely Des Moines, Iowa. That's where our home office for Fidelity and Guarantee Life is. Yes, it's freezing cold and snowing, so I'm very jealous of all of you who are dialing in from much warmer places right now. But I'll run an Iowa illustration. Generally, very little product variation, no differences, price and rates across your states. You'll just want to run in the state of the sale for your client. So we're selecting the Elite product because my client John today, he definitely has a need for that death benefit protection. He has a family, wants to make sure that they're taken care of if he passes away. But he also knows that he's not doing everything that he can to set himself up for a strong retirement. So John has a particular budget, and he's told me what that budget is, and he's asked me to create a solution that's going to give him that opportunity for tax-free policy loans later on. Now, maybe that's not how our client is saying that, but that's the solution that we're trying to get to. I know my client's premium amount. What I want to determine is how much death benefit I need to issue him in order to keep that growth tax protected, and I also want to illustrate policy loans. So the steps for running that illustration is, first off, always start with the information that you know. And what do we know in this scenario? I know my client's premium amount. I know his budget. You'll have the option, of course, in the first section, client information, to make any changes that you need to make to your underwriting class, perhaps to your age, etc. But we'll just leave it standard, not tobacco. We'll go very straightforward here today. So I scroll down first to the information that I know, which is the premium information. I'll make this screen just a little bit bigger here. The premium information is where I'm going to start because that's what I know about my client. And John has told me that on a monthly basis, he wants to pay a specified premium amount of, let's say, $300. Now, maybe your client has more, maybe they have less. Again, this is just guiding you through the illustration software to create that solution. So I've selected monthly premium for my mode, and then I get a pop-up when I choose specified that allows me to enter that premium amount. So I have my premium amount entered. Now, John does not want to pay premiums forever, right? He wants to pay it while he's still working, and then he wants to stop paying premiums and start taking policy loans. So how do I do that? Well, I find the easiest way to do that is right again on this main input screen, pay premium to A65. That will stop my premiums at age 65, at which point I can solve to turn on my loans. So again, A65. Conversely, this same field works for policy years. So if you have a client that you want to show paying for 30 years, I could say year 30. So A or Y will designate either a policy year or an age. So super straightforward. Step one, I entered my premium information for John. How much does he want to pay and how long does he want to pay for? Hopefully we're a thumbs up on that. It's hard on a webinar. I envision thumbs up in the air, so maybe hopefully you're doing that there in your office, but we'll keep moving forward assuming I'm getting those thumbs up because I don't see any questions coming in. So step one, premium information. I know my client's budget. What I want to do, thanks so much for the thumbs up through the chat, appreciate that, is I want to solve for the minimum death benefit that my client needs in order to make those premium contributions. I then also want to illustrate policy loans. How do I do that? Well, that's where our max accum and income solve comes in. Again, as I mentioned, and you see here, there's a lot of different solves. These three, max accum and income, face premium, minimum DB, those are going to be your closest friends. The other ones might be acquaintances, but those are going to be the ones that you use the most. So max accum and income is what we're going to use in this scenario. I get a new window popping up, and this new window is asking me, what are you solving for? Well, I'm not solving for premium. I know my client's premium. I want to solve for the face amount. So as soon as I check off that box, I get a pop-up reminder of what my premium is. Awesome, good to go there. It's going to save what I've already entered, including the paying premium to age 65. Now we have a cash value target. You have a couple of different options here to do. What I encourage you to do is at age, you either want 0, 100, or 120. You're not trying to illustrate a particular cash value at a certain age, what you're trying to do is draw out the maximum amount of money while keeping the policy safe from lapsing. So I know what Gina likes to do here is $5,000 at age 100. That's absolutely a good way to go. Or you could illustrate, $5,000 or $100 at age 120, something like that. If we illustrate at age 0, just going to pull the most out, not try to retain a particular cash value. So we'll go with 5,000 at age 100, again, which is going to give us really good policy loans coming out, but make sure that the policy stays in force. Why is that important? Well, one, my client needs that protection. Number two, perhaps more importantly, those policy loans are only tax-free as long as the policy stays in force. So if I start drawing out too much money too early on and the policy risks being lapsed, or if the client chooses to surrender it, he's going to have tax implications for all of the policy loans that have come out. So that's why we want to make sure that we illustrate, anytime we're illustrating loans, that the illustration goes all the way out to client's lifetime. Next up is our income type. We're going to be illustrating loans starting at age, 65. This will actually show up on the illustration in the year following when we stop paying premiums. So it will begin at age 65 but show up in line 66. Trust me on this one, it's a little confusing to explain, but you'll want to start those loans in the same age that you stop your premiums. Years. This is going to be your duration. How many years do I want to illustrate loans? So if we want to go to age 100, what is that? 65, 75, 85, 95, 35 years, right? So if I'm illustrating loans to age 100, that would be 35 years. If I'm doing to age 90, which quite frankly is probably a little more reasonable. I have yet to meet a client who lived to 100. Perhaps you have. We'll illustrate loans to age 90 in this particular scenario. Your loan type. Again, we went through what a variable and a fixed option are. We'll go ahead and run fixed loans today, but you would make that selection down here at the bottom as well. And I click OK. Now I can assure you that the amount of time it will take you to run the illustration is far less than it just took me because I, talked so much, right? It's really just 2 steps. Go in, enter my premium information, come up, enter my solve. That's it. We're ready to roll, view and print illustration. So again, the design here is one that's going to be very common. You know your client's premium contribution amount, you know their budget. What you want the software to solve for you is what is the least amount of coverage that I need to issue on my client to keep this growth tax protected. And then I want to also illustrate policy loans. So that's what the solve is determining right now. We'll bring up the illustration, walk through it quickly, and then we'll talk about how we can fine-tune based on some of those case design scenarios we discussed. So here we have an initial death benefit of $262,000. Let me increase the size of this a little bit. Face amount of $262,169. That is solving for the minimum non-MEC death benefit for this client given his premium amount, his age, his gender, his underwriting class. He's contributing that $300 per month. Again, it will be shown on an annualized basis, but it's assumed to be paid monthly until age 65, at which point he stops paying premiums and we start illustrating policy loans. So you see those loans here in the amount of over $16,000 per year, continuing annually all the way through through age 90 is what we did here. And then as we mentioned, that policy illustration is still carrying out all the way to age 120. So I still have a net death benefit. So hard to highlight on this software. We still have that net death benefit continuing all the way out through age 120, which is maturity, making sure that my client retains that coverage. And I misspoke. The initial face amount is $242,169. I mixed up those numbers. Thank you for the feedback, Holly. Appreciate it. So we've solved for the minimum non-MEC death benefit at an option A, illustrating $300 a month going in through 65 and then policy loans. Simple enough, right? 2-step process. Now I received a question, and Lucero, you must have read my mind because the question was, are we not doing option B? So we just walked through when we would use option B to A versus option A. And yes, let's absolutely explore how to do that. So I'll pull that illustration over to my other screen so we can compare a little bit. Let's say I want to look at the same client at an option B. So I want to drive that initial death benefit down. Remember, that's what an option B will typically allow us to do. So I want to drive that initial death benefit option to B to bring that base face amount down, save on costs and expenses early on. But remember, over time, that net death benefit is going to grow. So my recommendation generally in this type of design is that you want to choose the death benefit option going from B to A. And we actually have that selection on the software right here for you in face amount. So I would choose varies, option B to A, and I'm going to change that death benefit option in the same year that he stops paying premiums. So again, this is going to give us a little bit of a different solution. It's going to give us less initial death benefit in order to grow my cash value a little bit more. And at some point in the future, my client is going to need to initiate a change from option B to A when he stops paying the premiums to protect that death benefit from continuing to grow. So while we allow that to run, just a refresher, what we had before was an initial death benefit of, let's see if I can get the number right this time, about $242,000 was our initial death benefit. So if we look at our option B to A illustration, look at where our initial death benefit is. It is more than cut in half, $94,000. So great for accumulation, not necessarily great if my client needs more coverage. So that's why I say option B to A might not always be the best for all clients, but we can see here the implication for accumulation. So we had on our other illustration about $16,000 coming out. Now we have about $17,300. So a little bit more on a larger size premium that would be exponentially increased. On a smaller premium amount, it's not going to make that much of a difference. Because here, by the time we get to age 65, my net death benefit would be just about where it would be on the option A anyway. In fact, it's a little bit higher. So I'm starting to pay for a little bit more in COIs here as the net death benefit increases. But again, we can start at a smaller amount, that $94,000, in order to protect some of the costs in the first couple of years or in the earlier years and grow that accumulation better. So that's how you would run the option B to A switch. And if you're running that, a great thing in our illustration software is it's hard to miss that you ran that because we'll actually highlight in that darker green color the year in which that death benefit switch is made. I'm going to pause for a moment because I see a bunch of questions popping up, so I'm going to do my best to answer those, and then we'll move on to a couple new scenarios. So one of the questions, is it possible to make that change automatic in the future? So the policy change from option B to A, no, it is not. The flexibility of an IUL means that the client can follow this design or can use the policy in a different way. We will issue the policy based on the initial parameters, so the initial death benefit and premium amount. But the great thing about an IUL is that, if my client wants to increase or decrease his premiums at some point, maybe stop paying earlier, stop paying later, maybe not take policy loans, all those things are up to them over time that they can decide, which means we're not going to build in any of those changes. And again, it is up to the client to initiate that change from B to A in the future if they choose to. Another question, if I'm doing this design, would the beneficiary still get the cash value along with the death benefit? Thank you for that question, Charlotte. Appreciate that. So if we're looking at an illustration, we're going to focus on the non-guaranteed column over here on the right-hand side. Let me see if I can highlight this here a little bit. Non-guaranteed assumptions. Now, if I look at my net death benefit column here, that is assuming the total payout to the beneficiaries, which at an option B is going to be my base face amount plus my account value. So the question is, if we do that B to A switch, are they still going to get their base face amount plus the account value? We would actually be calculating that right in here. When they make that change, they would still be getting their net death benefit. So it still is going to be a combination of the base face amount and the cash value or the account value, because at the time of that B to A switch, they actually buy up the insurance up to that level amount. I know that's a little bit complex to understand without diving in too deep. I'm trying to explain it as simply as I can. But when you do that option B to A switch, yes, they're going to lock in the net death benefit that they have at that point. And going forward, well, the reason why it's decreasing here is the loans, but going forward, they would be retaining that level amount. So yes, if they go from B to A, they still would be getting the death benefit plus the account value that has built up until that point. And then from that point forward, the account value is not going to be dumped in on top. One last question before we move on to another scenario from Amanda.
Emily.
Can you go? Yes. Go ahead, Gina.
Before we move on to that, because I get a lot of questions about that, adding the cash value and the death benefit. Even if you're running one of these at a straight option B, you never want to tell the client they're getting both what's in that cash value and death benefit column. The software is going to automatically add what needs to be added. So if you do run it at option B, they don't get the cash value column and the net death benefit column. The net death benefit is all they get at death. And the cash value will already be added in there. I just want to reiterate that because I get a lot of questions about that and agents wanting to add the two together. You never want to add those two together.
Thank you so much, Gina. Appreciate that feedback, and you said it much more succinctly than I could have. But I think the good news here and what to remember is that the illustration software is calculating that for you. And to Gina's point, we're not going to be adding our account value on top of what we're seeing in our death benefit column because this is, whoops, scrolled too far, a net death benefit. It's titled that way because we are doing all of that calculation for you. That is the projection of what would be paid out to the beneficiary. So thank you for that clarification. I can understand how it's a point of confusion, but the illustration software does all the math for us, and we should just allow it to do so. Make it easy for us, right? So one last question about death benefit option was from Amanda. Can you go from option A to B? Yes and no, and here's why. Technically, you can go from option A, level death benefit, to B. It would be required that there would be underwriting at that time. Why? Well, because you're going from a level death benefit to a increasing one, meaning that we're adding on the account value to the base face amount. So we're giving the client a larger payout, and thus there would be additional underwriting required at that time. There would really be no, from a case design perspective, I cannot think of an instance in the almost 10 years that I've been working with IUL products that going from option A to B would be in the best interest of the client in vast majority of the situation. So while it is possible, there's underwriting required to do so, and I am hard-pressed to think of a scenario in which going from A to B would be beneficial to the client unless they need more insurance, in which case they absolutely can, keeping in mind that there would be additional underwriting at that time. If you're talking about accumulation, A to B is not going to be your best approach. It will be B to A or straight option A. So to answer your question, yes, it's possible, but there would be underwriting required at that time. Moving along here quickly, thank you for your question, Carrie. I'll get to it in just a couple seconds. Quite a few coming in, Glenn. Good question. So hang tight. I will definitely answer both of your questions here in just a couple moments. So moving on here to, we've covered maximum accumulation and illustration solves with a specified premium. We've talked about how to stop paying premiums at a certain age. We've talked about option B to A versus straight option A. The next solve that I want to go through, and you know what, I'm going to start a brand new case so we can start fresh, just like we're, and it's already 5 minutes out. So let's do this one here quickly. I have a client that I know how much income I want to project for my client. What I need to solve for is what the death benefit is and what the premium is in order to get him there, right? So the client has an eye towards those tax-free policy loans during retirement, and what I need to do with the illustration is figure out how to get him there. So for this client, I know how much I want to illustrate in policy loans. What I need to solve for is, again, the funding and the face amount to get me there. This let's do a 30-year-old client. Again, this is just for demonstration. You would follow the same process for a client perhaps of a different age or with different needs. But this is where you're going to use the face and premium for a specified income. What does this mean? Well, I'm going to say I want an income stream of, let's say, $70,000. Ooh, not 700. That would be good. $70,000 a year starting at age 65, and let's keep that continuing through age 95. Again, we'll illustrate on fixed loans, but we've talked about what a variable loan is. Our cash value target, we can keep that at age 0, or like we did before, 5,000 at age 100 is absolutely fine as well. Click OK. So this is saying at target premium, what is the face amount that would be needed in order to generate the $70,000 per year during retirement. Now, my client does not want to pay premiums forever, so I'm going to go back down to my premium section, and I'm going to shut those off at age 65. Simple enough, right? So this one may take a little bit of time to generate the illustration because it's doing quite a bit of calculation here in the background. So while it is generating, I'll jump over and answer a couple of questions. Where can you get the link to download the software? We'll go through that here again at the end, but it is housed in the Alliance back office website. You would simply choose the carrier pages, go to F&G, and you can download it there. I'll spend a little bit of time when we wrap up talking about illustration rates or illustration percentages to that question. And I would think this is going to answer your question too, Carrie. We should always say these are projected amounts, correct? And that is accurate. The illustration is designed to give our client a concept, to give them an idea of what this solution can provide to them. The only guarantees are the guarantees in the policy. So giving our client an idea of how it may perform, knowing that there are going to be years that they're going to get more credited and years that they're going to likely get less. So it is to give them an idea of a concept rather than having our clients get married to the numbers. I think that's a great call out, Carrie. Thank you for that. So this illustration is telling me that in order to illustrate, here we are, $70,000 a year in tax-free policy loans, I'm going to need to start off with an initial death benefit of just over $1 million, and that amount, when funded at target premium, is going to generate that policy loan projection. So again, that's not a max funded design, that's a target premium design, but showing at target premium, that's how we can get to that policy loan amount. Now you can do the same thing on this one, option B to A, same type of thing. You still have those options when you're running the illustration, but that is your face and premium for specified income solve. I want to do one more here really quickly. I know we are out of time, so thank you so much for your attention and participation here and sticking around. One more solve I want to go through is about adding in 1035 or a lump sum. So we talked about this a little bit. Let's take a look at a 40-year-old here on the Elite product. How do I add in a 1035 amount or a lump sum? Well, let's say that my client has that same amount of premium that we first illustrated. So let's say he has $300 a month. Again, I'm starting off with my premium amount, $300 monthly. He wants to pay that to age 65. And at age 65, I want to stop paying premiums, age 65, and start turning on policy loans. Now, in addition to that, he also has a little bit of 1035 money coming over from another contract that's not working well for him. So I would click on, I might have done that too quickly, lump sum checkbox will give me an option to add in 1035 amount. Let's say he has $10,000. And that, when I run the illustration, is now going to take into consideration that additional 1035 money when it's doing the solve. So it's now going to say you're going to have that additional 1035 in addition to the 1035, and I can continue the same way that I would run the other loans. So that's how we would add in a 1035 amount. Same concept for lump sum. you would simply make sure that you don't choose a 1035. So a lump sum would be anything coming out of the client's pocket. We talked about putting in a large amount. Typically, again, not recommended. So if the client can distribute that over time, I would recommend it. But if they do have additional out-of-pocket premium, you would enter it in the same section. So walk through a lot today. I know it was very quick in some instances, but we dove into some of those case design concepts. We walked through how to create that accumulation sale for our clients, how to create that maximized potential for tax-free policy loans for our clients. And then we went through on the illustration software how we do that. It's a couple of simple solutions. I know that those illustration solves can be a little bit overwhelming. So again, focus on those three that we talked about. Think about your client situations, what types of conversations you're having with them, and I do believe that the majority of the scenarios that we encounter with our clients will fall into these categories. So I'm seeing a bunch of questions coming up, which I will do my best to answer as many as I can. I understand if many of you have other meetings or appointments you need to attend, please do feel free to drop off just with my thanks for your attention and participation. But if you do have time, I'm more than happy to stick around for a few moments and answer some of the questions that came in. Now, if you do have questions that Gina and I can't answer today, or something comes up as you get into the software, where do you go for help? Well, there's a ton of resources out there available to you. First point of contact I would direct you to is your manager. They're a great resource that can really help guide you through your case design questions, product questions, as well as on the illustration software. You also have a team at the Alliance who can assist you. So as I mentioned, Gina is an expert and she can assist in guiding you, so feel free to contact them. And in addition, we have a team. Your case managers here can also answer your questions about illustrations and help guide you through that. So I want to make sure you have that contact information. And with that being said, I'll choose as many of these questions as I possibly can to work through here in the next 5 minutes or so. Hold on, I'm just going to read here for a second. If the client wants to take out a lump sum loan after premiums have stopped, so I illustrated here level loans coming out, so typical retirement income coming out. If the client wants to only take out loans for 1 year or 2 years, you can do that in the illustration software. You would just choose a duration of 1 year or 5 years. And of course, you'd be able to get quite a bit more out if you're just taking it out in that 1 year. So again, if you're illustrating fewer number of years of loans coming out, you can do that in the software. Just select it under the duration, and it will only pull out for that many years. There's a question about selling to clients who are older age, specifically in their 80s. We do not have any IUL products that go through age 80. We would go through age 75. But typically, if you're looking for a solution for older age clients, meaning over 60 or so, I would point you to our choice product as well. And I think, Gina and her team can give you some direction on those older age groups as well. Regarding some of the interest crediting options, illustrated rates, let's talk a little bit about that. So let's take a look at this illustration once again. So illustrated rate here, non-guaranteed assumptions, is 8.26%. How is that determined? Well, illustration, as I mentioned, the NAIC has very robust illustration regulations, one of which that we talked about is called AG 49, Actuarial Guideline 49. But the illustration regulations are much more robust. And what those regulations are designed to do is to protect the client from seeing an illustration that's unrealistic. It's designed to set level playing fields for all IUL carriers and make sure that we're all following the same rules when we're providing illustrations, right? It's in the best interest of the client. So the illustration regulations also dictate how illustrated rates are determined. And here's the short version of how illustrated rates are determined. We look at the entire lifetime of the S&P 500, which is over 65 years of history. So over a lifetime of the S&P 500, every single crediting date, every single data point of those 65 plus years are taken into consideration in the calculation, a floor of 0%, and whatever that carrier's current cap rate is. That's how your illustrated rate is determined. So that 8.26 or 7.77, whatever that illustrated rate is when you run the illustration, is not selected because a company throws a dart at a dartboard. It is truly based on historical returns, long-term returns of the S&P 500, as well as current cap rates. Now, what you'll see on an illustration is 3 different columns: guaranteed assumptions, non-guaranteed assumptions, fixed, and non-guaranteed assumptions, current. What do each of these mean? Guaranteed assumptions on your left-hand side, also part of illustration regulation, says we need to show the client absolute worst case scenario. This means if the index credits less than 25 basis points every single year. So if the S&P takes a dive every single year for the next 20, 30, 40 years, which, by the way, it never has done for such an extended period of time, and if Fidelity and Guarantee Life all of a sudden decides that we are going to charge your client the highest cost, fees, and expenses that we can allowable by law, this is your projection. So that's your guaranteed assumptions column, absolute worst case scenario. Typically, in these types of solutions, you're not selling guarantees. You're selling accumulation. You're selling upside opportunity. The guarantees are there and will always be there to protect the client. But when we're focusing our conversations, we're really directing them towards the non-guaranteed assumptions. Now, this is not best case scenario, and that's what I like to specify. An illustration is not worst case, middle of the road, best case. Your non-guaranteed assumptions is truly, that kind of looks like an ice cream cone, what I drew there. I didn't intend to do that, but there you go, is truly based on historical performance and current pricing trajectories. So it's based on a reasonable assumption about where we think the policy is going to go. I have time to answer here about one or two more questions, so I'll pop up that contact information again. Please do make sure you direct your questions that I'm not able to answer. Who can make withdrawals or loans? Loans or withdrawals that are coming out are going to be paid out to the owner. The owner has possession over the policy. The insured is the individual whose life is being insured, but always the owner is who, one, owns the policy, and when loans come out would receive those loans. Do we have something to show the client, a projection of the S&P over a 10 or 20-year period? Charlotte, I love that question. Thank you so much, and it's a perfect one for me to close with. Yes, on all of your illustrations, where did my illustration go here? On all of your illustrations, you will actually have a historical projection coming down here on the historical performance summary page that we talked about the illustrated rates being derived from real performance in the S&P 500, and you actually have a chart showing exactly what that performance has been, both in the external index as well as within the policy. So we definitely encourage you to use those resources. Well, with that being said, I have used far more than my fair share of time today. Gina, was there anything that you wanted to close out with?
No, thank you so much. This has been very helpful. And I just want to remind everyone that this Saturday from 9 a.m. to 5 p.m., we are doing an IUL and annuity big premium seminar here at the office in Burlington, North Carolina. So if you're somewhere in the vicinity, it is a free event. And then during the event, Dean Vagnozzi is going to be here, as well as Terry Edwards, several other people doing training. But you will have the opportunity for a fee, and that fee will actually get you Dean's books to do a breakout, a 4-hour breakout exclusively with Dean. So I just want to remind everybody about that event taking place here at Alliance headquarters in Burlington this Saturday the 9th from 9 a.m. to 5 p.m. But thank you again, Emily. This has been very, very helpful information. And I also want to remind everybody, in addition to this being recorded, we do have a video out on Alliance University that also goes step by step on how to run these illustrations. So that's another, it's within the F&G Elite course on Alliance University. There's a supplemental video in that course that not only talks about the product, but shows you step by step how to go through and run the illustrations. But thanks everybody for tuning in and taking a little bit of extra time today. And thank you again, Emily. We really appreciate it.
Thanks all. Have a great day.
You too.